You want me to post it or save it?
You can post it for now. I'll ask you to post it again, but it just makes it easier to look for it. You guys are in for a treat. Yeah, and I'm sorry it's taking a little bit of time. Just having for some reason my headphones aren't working. All right, testing. Does that work? Oh, it seems like it's working.
Yep.
All right, perfect. So for people that don't know me, my name is TJ. Pretty much active trader. I trade full time. It's been about like 4 years that I've been trading about full time now. Started at an institution, so I have some information on the institutional side as well. So that kind of experience really gathered like a lot of knowledge for me of the market participants, what they're looking at, what I need to be looking at, and where I have better odds of success. Now, you have to keep in mind that there's a few concepts that we're going to be going through today. Now, these concepts aren't easy, and I'm not going to be explaining it in great detail. You guys can literally just go online and pretty much read about it. But the first thing that I wanted to mention is market participants. You really need to know who you're up against. Now, Tony, also known as Ben Traden, he has pretty much gave you a lesson intraday about this, and he talked about, you know, he used sports as an analogy, and he talked about basketball, and how the players that are playing like professionally, they are able to compete competitively. But if you try to compete with them, you would not like stand a chance, right? Now, the same thing happens in the marketplace. So, the first thing that I want to post is something that actually Tony posted in our group about, I'd say, like 3 or 4 years. That are like the rules. Like, these are the rules that you do need to follow. Now, if you're a new trader, don't think that you can read the news and know what's going on. We have algorithms now that can analyze it, make trading decisions on multiple different stocks simultaneously. So, yeah, by the time you just read that news, the market's already reacted. The reason that we say follow price action is because of one theory specifically. Can anyone guess what that theory is called? Perfect. Efficient market theory is pretty much what we go by, right? We assume that things are priced in right away. And I'm not going to go into in like detail about the theory itself, but that is our assumption. Now, is there going to be any outliers? Yes, there will be. There will be guys that are insider trading. There will be guys that are working at different firms, and as we've seen in the news, they'll try manipulating price. We saw that LIBOR was also manipulated, something that all the banks pretty much use. And if that can be manipulated, do we really think that a single stock can't be manipulated? Right? This is the entire concept of also looking at option volume, right? People look at option flow ahead of, let's say, earnings, ahead of expected news, ahead of FDA approvals for that one specific reason. Someone must know something. Now, that, like those words, are the worst words to trade by. If you don't know what's going on and you're basing your trade on someone because of option activity, and you have no other like thesis to get it into that stock, the odds are that you're going to be the chump and you're going to probably lose. Now, the reason why I don't specifically follow option flow is one specific reason. On the diagram that I'm just about to post right now, well, it's a pie chart. So when you take a look at that, you can see that stock picking is less than 10%, guys. Majority of the activity is broad index derivatives, right? Then we got ETF and ETF and ETN funds. We got high frequency traders. We got, algo trading, and we have options hedging, right? So how are we supposed to know if that's a play on the long side or the short side? We really don't, to be honest. Not like definitively. We don't know when they got in. I mean, if it's an option, contract or, leg that's like never traded, like it has probably like less than 500 average volume. But then sometime in January, you saw a huge amount, a huge spike on it, right? And then sometime in March, you see another spike. And this time it's on the bid versus the last time, which was on the ask. Then you can be like, okay, I kind of know based on the entry, the size, I can kind of like put it together and be like, okay, that guy just got out of his position, right? Now, that's not true for everything. Most funds will allocate I'd say actually 1 to 3% of their fund for hedging. Now, you'll notice this too. So we have Ray Dalio, runs one of the biggest firms, and his firm came out with news way before the market just tanked, where it was like he's taking $1 billion hedge. For the normal retail trader, that's like, oh, that's a lot of money. That's a huge hedge. When you actually look at his assets under management, that was 1%. 1%, right? So for us, you have to understand there are bigger fish in the sea, and they are going to be playing a factor into this, right? Now, when you look at that pie chart, you'll notice that, okay, majority of the trades are going to be on derivatives. So anything that happens on the marketplace, why is it so exaggerated? It's because of this. It's because the derivatives are being traded, because that's where their quants really shine. That's where the public doesn't have as much knowledge about, and that's where their skill sets really, really shine, right? They have teams of analysts, and you have to remember this. You are playing in the big leagues, and your small positions, my small positions, to be honest, relatively speaking, does not make a dent. Theirs will. So, what happens when you trade a leveraged product? Let's assume it's options in this case, and a huge order goes through. Have you looked at the relationship between that stock price and then the actual option? As soon as that trade happens, you'll see a spike on the equity side. That spike is because there's also algos that now trade based on the activity in the option side. So now you have multiple participants all making their speculations. Some might be right, some might be wrong, but this is also a zero sum game. Now, I want to also clear one thing. So, investing is totally different from trading. In investing, as long as GDP is going up, you have money flowing into the markets. As long as you're invested, you're technically making money, right? So, essentially, it's not a zero sum game if you're investing, because any given 5 year time period, you would have made money in the markets. Statistically proven if you just bought SPY. You guys following along so far? Perfect. And please take some notes down, guys, because this will help you. You need to know your odds, right? Now, when it comes to trading, how many of you guys are familiar with the game theory? All right, so I see a lot of people saying no, a few saying yes, and the people that are saying no, please study this tonight. While it's fresh in your mind, I want you guys to really study this, because this is going to, factor into your play. Now, let's say this. Okay, so we know it's a zero sum game. We know 99% of traders fail. But to be honest, that's the same odds in everything. 99% of basketball players that try and go major league, they fail. Same thing with every other sport, every other pretty much industry. Everyone wants to be the S&P 500, Fortune 500 companies. Yet there's like more than like what, 16, 18,000 different stocks in the stock market. You guys get it? That 1%, yeah, there is a 1%. And to be honest, 99% of people fail. But if you really dig down to it, why do they fail is the real question. Like, what are they not doing? And it's simple. They're not modeling their success looking at the best. So, we all know about Kobe Bryant. How much hours does he put in versus the next best basketball player? Pretty much a shit ton. Double, at least double. Is this something that he did for a year? I don't know. I'm asking, to be honest. It's his entire life. There we go. Right? So his entire career, he's been doing this. So you have to realize the 1%, the 1% for a reason. Now, I'm not sure if you guys are familiar with the cutthroat environment, but, if you take a look at Goldman Sachs, for example, those guys barely sleep. They'll sleep in their offices. There's guys that will work Saturday and Sunday. And to be honest, me and Johnny, we used to work on Sundays as well. We found that to be a little bit better because then I can take Mondays off just so I can trade. So the first 7 years, the most important thing for me was, how do I get here? How do I get to a level where I can trade for a living and not have to look back, right? That's the biggest thing. How do I set myself up to succeed? So you model yourself using the best of the industry. Now, one thing United Traders brings to the table is we have experience now. We have experience on the institutional side, on the trading side, and pretty much just overall knowledge, right? Now, based on the environment that you're going to be trading on, you're going to succeed, right? Well, or fail. So, what's really important is to know that these guys play as a team. How many analysts do you think one of the biggest institutions have? Just guess. I'd say hundreds, if not thousands, depending on which firm, depending on how big they are, right? Now, how many funds? I mean, if you take a look at just Bank of America and you take a look at how many funds they offer, you'll notice something. Some people are the same, but usually there's different people. So different analysts, also different portfolio managers, they have different teams that they've set up for themselves. So there are so many different market participants, so many speculators in this game. Now, some of the best traders are the guys that played poker. And that's because they understand game theory. Now, I'm just going to quickly I'm not going to be talking about poker here, but you're going to see people referring to this. This is something they memorize. Why would they memorize what they should be doing on this? This is like the pre-flop strategy because you have your best odds. So, what are they doing? They're taking the necessary steps to play the best hands, right? They know when they have an edge, right? So, going back to that first picture that I just posted, realistically tell me, are you smart enough to understand the news and how much it's going to affect the markets? If you are, that's great. Okay. But even as an analyst, as a quant, I am not able to fully understand every single market dynamics. There is a reason why I don't trade commodities and I stick to one little niche market, which is US equities. And within that, I like tech sector, right? I stick to that because that's where I have an edge. I don't have an edge in biotech. I don't have an edge anywhere else. Now, a member actually brought up a good question. It's like, most of the analysts are analysts. They don't know anything about bio, and that's true. But to be honest, we can afford to pay a biologist. In my case, um, I was able to get a pathologist and speak to her and find out the information that I wanted to know from an expert. These kind of consulting services, there are a million of them, right? It's the same thing as any other consulting service. So don't think that, oh, the market isn't smart because they don't understand biology. They don't understand the implications of a coronavirus. No, things can be modeled, guys. Everything that we expected can actually be modeled to a certain degree. Now, this sort of information, especially when you look at the models that's coming out right now, like we can definitively tell you how the curve's going to change now, just based on the previous data that we acquired, right? So yeah, science, math, and technology has become that advanced that you can actually see it, right? And it's the same concept of the flu. How do we know? Like, how do flu vaccines get, I guess, like produced? Every year it changes. They model it. They look at the change and they're able to predict it and then model accordingly, right? Now that's based on data. So you have to remember in almost every industry, data is important. So for me, stats is everything. Most of my time when I am not trading, all I'm doing is looking for stats, as you can see in the microeconomics channel. These are stuff that's going to give me an edge because I can analyze data, but I don't have access to all that data. So I look for indications from different sources. I don't read the articles. I don't want any opinions. I just want to know the hard data and then make my own assumptions. Now, that's based on my skills from actually understanding some of the market dynamics. I understand, the valuations. I run DCF models when I'm looking at long-term investments, and as you guys can see in the long-term channel, like my long-term portfolio pretty much outperformed like every different index, right? In the same time period, outperformed it. Now that was based on models. Now I can tell you what's going to happen 5 to about 6 years. Actually, let's say 3 to 6 years down the road, based on the data that I'm given on a company. I can't tell you the market implications. I can't forecast changes in, like the coronavirus and stuff. That's something that I don't have skills with. But there are data scientists that can gather that information, interpret it, and you're able to actually use that information. And that's why we always say information is key. Now, do you guys know the history of SAC Capital? Steve Cohen? No, or is it Steven? Forgot now. Well, these guys got pretty much pinned for insider trading, right? So they were able to do something that a lot of people, um, well, it's frowned upon. Plus, it goes against the efficient market theory, where things are priced in on the market based on public information. This is actually insider information. Now, this information itself, they've gathered from different sources. And at that time, there used to be like a service where you can call. It might cost you 30, 40K. And you can call them and be like, hey, I want to speak to someone that works in, let's say, upper management at one of the Amazon, um, what do you call it? Amazon distribution facilities or fulfillment facilities. There we go. Right. So that phone call cost them a lot of money, but they're able to talk to someone that actually has that information and was able to give them that inside information. Now, to be honest, it still does happen. It's something that does occur, but those are outliers. That does not mean that it's going to always happen. So every day I come into the market, I already have a biasness from the previous day. But every day I reset my biasness because I believe in our technology. I believe in the algos that are trading it. I've seen it. I've designed one. And to be honest, I know how effective they are, way more than we are. And you always want to know that that's okay. That's your hand. You don't have to be perfect. Now, game theory goes into it a little bit more in depth. Let me just find the picture here. These are some components that you really do want to understand. Now, I'm not going to go over this. These are stuff you have to do on your own. I might do a lesson on it later. Mine's is a RL model. Pretty much it does real time valuations based on my parameters. And so far, backtests are good. But implementing it into a trading, like automatic execution, that's a little bit more trickier. Also costly. But mines are pretty much designed based on fundamentals. Technicals are a little bit easier, so I can always like get that done afterwards. But yeah, for me, it's like the biggest thing that I want to do is save hours of analysis. That is why you can see, based on my last 2 years, if you look at my calls for any swing trades, you'll see it's just amazing. Probably like 98% win rate. Now, let's take a look. And it's not all about win rates, but still beating the market is also important. Now, so the market dynamics, this is something that you do have to understand, right? So now you want to understand the players. So the players, as you can see from Ziggy's post, Ziggy, go ahead and post that again.
Yeah. I'm scrolling up.
Also, I did a lesson on this previously on market participants. So I highly encourage just reviewing the material. I'm not gonna have to like repeat everything again. So now we know that, okay, these guys have an edge. If you're an investor, you have had an edge. So how do we trade? Because TJ, you're just telling us 99% of us is going to fail, and that's true. But it's not also like like the rate of failure. It's more about like what's causing the failure. It's not understanding the concepts mentioned today, and secondly, it's not understanding yourself, like where you have an edge. People try and price in news, right? I don't. Like we played Tesla on the deliveries, right? The first thing I did was easy. I took a vert. Playing an option vert was a safer way, just because I didn't know which way it's going to go, but at least I had some protection. And then eventually theta is going to just, ruin, well, technically decay it. So no matter what, I can actually be profitable on it. Let me just copy this image here. Now, as you can see, the one main important key factor in game theory is strategy, right? So, someone tell me, how do you form a strategy? So, there's an actual process to this. And if you follow this process, you will learn from it. The members on our dream team that I'm personally training, they know this process. And as you can see from the results, they are absolutely destroying it now, right? Now, here's the problem that I've seen from, running a group of like 10,000 people. You don't allow a trade to actually work. You don't allow your strategy to work. So your data set is all like screwed. Secondly, you can't stick to a strategy long enough for you to actually see results, to build conviction, to build confidence in a trade. That's stuff that you actually have to do. Now, is it going to cost you? You don't actually have to. Like we've mentioned several times, you can paper trade it. And as soon as you're done paper trading, go with a like you guys have free trading. It doesn't even matter if you have to trade like one share, to be honest. I would highly recommend, trying to do it that way as well, just like to see if the strategy works, not just on paper, but actually in the markets. Test it out. And I say you need at least 100. I think you need at least 100 trades for you to be able to say, hey, this might be a viable option. Here's the steps that you want to take to create a strategy, right? You're going to plan it, analyze it. Is that design? Oh man, someone spelled that one wrong. Implementation, testing. You just keep doing this. You're just going to actually keep doing it multiple times, you really do have to kind of like reassess your strategy. Every time your strategy is going to evolve as you evolve as a trader. Now, you're not going to evolve as a trader if you're not putting in the work. You'll see me. I do like 18-hour days on this, and it's not because I have to. Actually, no, it is because I have to. Because if I'm not doing my research, someone else is, and they have a better hand than I do. And according to game theory, if you want to be the top, you actually have to put in that effort, right? Now, here is the definition of strategy. And you see us mentioning this multiple times. What's your exit strategy? How are you going to implement a trade? What are you looking for? When do you size up? These are questions that I can answer. Now, if it's just questions like what is a put and a call, guys, there is online resources for that. It's not the best utilization of our time. So these kind of questions are stuff that, we really perfected, something that I can analyze and I can actually definitively tell you. And that's not just based on, my own P&L. I actually started the dream team for that one specific reason. It's like, okay, I know I'm a good trader. I'm consistently profitable. I can make big bets. So can I teach someone else to do the same? And as you can see from the results from other traders, honestly, some are even doing better. I mentioned this the other lesson too, but like I have to give a huge shout out to Diane. She is not going to go into her personal business, but she's a vet, and she is trading and kind of like learning, and she's been in the dream team since the start. I really respect the fact that she always posts the news. She always, like, literally every morning when I wake up and get ready and sit down on my desk, the first thing I see is her news articles, and I see the relevant news that's affecting it. I saw, like, this morning, for example, Apple was saying that semiconductors aren't doing great, but then I noticed that some of the semiconductors were up. That got me into digging. If I didn't see that post, I wouldn't have even looked at that, right? So I do appreciate the work, and I don't know, maybe it's the military background, but she's always consistent with it, and that's something you need. Consistency is key in everything you're doing in life. If you model yourself after the best, you'll notice they are consistently doing certain things, maybe in a different order, but they have that consistency. Now, this isn't a field where you're just going to make money. If people can make money following calls, there would be no reason for hedge funds. There would be absolutely like no reason for you to even be in this chat room. There would be a chat room that everyone on CNBC to everyone else would be talking about. To be honest, there wouldn't even be a need a CNBC, right? We look at CNBC to kind of get like an aspect of the news and kind of see what's moving the momentum, the sentiment of the marketplace, what's actually moving. And, they bring on special guests like CEOs of certain companies that we might be interested in. That's what they offer us. If we're following calls, would we actually need them? No, right? So really put that into perspective. If you can follow calls and make money, everyone would be doing it. Now, let's take a look at the next topic here. So, strategy itself is something you have to come up with yourself. One strategy is not greater than the other. Each one has its own nuances. You have to figure out which one works for you. What's your risk appetite? How long are you going to be holding on to this stock if it goes against you? Like, how much risk are you going to expose? Are you actually able to expose yourself to that risk? Are you taking money out of your account? These are questions we can't answer for you. We don't know this kind of stuff. I can tell you about mine. I can't tell you about yours. So when people ask us, hey, is this a good time to buy? I'm like, we don't have enough data, information to actually give you a solid answer. And guess what? Even if we did, it's probably going to be the wrong thing. The moment you have to ask us if this is good, just get out of the trade. Now, that's pretty much like the concepts I want you guys to also know. Now, one more thing. Yesterday, you saw that at the end of the day, I made like a risky trade on holding into ES, right? We know that there was going to be a move. It was just like statistically, this is where the odds were in my favor. that it was going to go in one direction. Today, I did not mention it, and the opposite happened, right? Because one day I had a hand that I know I had a hand, and I was in my zone. I knew I like to a certain amount of, I guess, like a certain degree that it could go in my favor, right? And it was worth a shot. Today, I never did that same trade because I didn't have that same confidence. Now, you'll see this with every single market participant as well. We all know about Bill Ackman today, right? We all know about him last week. We all know about the money he made on his hedge, right? Because that's relevant news. What do you guys remember what happened like 3 months ago with him? Was he even on the news? He wasn't, right? You'll see this. There are times where you have a solid hand. That's when you take big bets. You'll see that with me too. On LK, when I bought it at 406, I was like, this is a steal. We're going to get a mean reversion, an easy, quick play up to $10, 150%, easy run, right? On that play, I went pretty heavy into it. I wouldn't do the same thing like today or any other day. Even if it's at $4 again, I wouldn't do it again. It's a different type of setup. And I see a lot of traders failing because they're like, hey, I'm going to use size on this. And then the next day they expect the same results. That's not how it works. And you'll notice this with every single person. You'll notice this from Carl Icahn. You think he makes big bets on every single trade? No. There's certain bets that you can take with some sort of like a degree of certainty based on their skill sets, right? And I always want to like advise you on this. It's like, guys, if you're not up on the day, don't take risks. Take what the market provides you, play in the direction of the market, and as soon as you're in the profits, you've made some money, that's when I risk it. For me, it's not about like bringing home dollars anymore. It's more about like pushing myself to that extreme where I can actually like get a bigger chunk of the pie. And for me, it's like, okay, that risk is worth it. For a normal trader, when you're starting off, if you need that money to survive, that's probably not the best idea. And let's say you do need the money, then you have to do what I mentioned. The first little bit, try and get like build your account, smaller trades. Don't try and hold off like we did. Yeah, we were able to get like $80 on SPY. Well, yes. Today alone on just 2 trades. For a new trader, I wouldn't expect you to do that. I want you to first learn to like grow your account, keep that money there, and I always advise keeping at least like 10%. I know it's harder on something like ES, but there's always MES. And personally, it's a really risky business if you don't have stops. So make sure that you have like decent stops and you know your limits. Now, someone tell me, what would be considered a good strategy for trading open range breakout plays? Yeah, you're going to have to take profits. Okay, open range breakouts, they're not going to last long. It's the most volatility. So if you're going to be doing that kind of trade, honestly, you don't even have time to set a stop. You're just going to have to get in and out really quick. Is that something you're going to be holding on for dear life? No, right? You have to be really fast, reactive, right? And you have to, well, kind of like proactive. You have to know, okay, this is my target, this is my exit, hit it. And then as soon as it goes one direction or the other, you have to execute it flawlessly. How many people can actually do that? That's a new trader. You can't. You have to learn. Just like Tony says, you actually have to build that skill sets. There is a reason people train. And it's the same thing with stopping out as well. You guys actually have to get that training. And honestly, it is a lot of work. So if you don't want to do it, personally, that's why I always say 80% of your money, invest it, 20% play with it. But don't be like going all in on your account. I know a lot of traders are taught to do 2% of your account or something like that. And yeah, in theory, it works out. But what about that one time that you freeze up in a trade, that it just goes against you, $7 a share right out of the open? You're just going to go back to square one again, right? So for me personally, I like to trade based on lots. So every 100 shares, 30 cents risk, 60 cents profit target. I think that's the easiest way. I think sorry, not Tesla. AMD is one of the easiest one. MU, and to be honest, the easiest one would be like Bank of America, BAC. That's probably one of the easiest ones that you can kind of like build a strategy in a safe environment and make some money without exposing yourself to too much drawdowns. Yeah, like what Ziggy posted, that's how it should look. But come on, guys. How many of you guys ever, like, I think 1% of my open range breakout trades just continue to ramp up the rest of the day. Most of the time, it's not. And that's okay too. There's always another entry. Don't FOMO into it. This is what people think. Okay. People think that in trading, your indicators matter, your entry matters, and then everything else is just like a small degree of effort. That is not true. What it takes to be profitable consistently is continuous improvement, which means you have to analyze everything. Like you have to, in the morning, you're analyzing the data that's coming out. You're going to analyze the market's sentiment. You're going to analyze the news that's, came out overnight. You're going to look at the other markets to see, like, to gauge, hey, how did the European markets do? How did the Asian markets do? You're also going to be looking at which news is affecting the stock that you're planning to trade. What are the levels that you want to trade between? You notice how entry, exit, and stop loss, if you were to just put it in a separate pie, they'll all be worth about 33%. So just think of it this way too, logically. If you go in with the entry and you go in with an exit in mind, but you don't have a stop loss, you're missing 33% of that pie, right? Like you're at a serious disadvantage already. Now, trade management, that's a skill that you will kind of grow into. You notice that sometimes I trade and instead of honoring my stops, I'll get out early if it looks weak. That's trade management. That's a skill set that you will develop once you learn tape reading. Um, you know, Reading kind of like the sentiment, like is that an actual good entry? Was this a pullback entry? Is this going to continue to tank? Did you just catch like the bottom on a trade? These are stuff that you're gonna kind of learn, and as you can tell, it's stuff that doesn't always like work out in your favor. It's something that you're constantly going to be improving on. Risk management, that's on you. How much risk you're going to expose, again, depends on you. That's why I don't like people doing the 3% of your portfolio, or like 2%, how much you want to risk. New traders have not deserved the right to be like, yeah, I can do it that way. You technically don't have the right, because stopping out is not easy. This is your money. Maybe it's easy on a paper account, right? I like, believe me, on a paper account, I'd probably be like, like short spy since February and just like hold on to it, right? Realistically, it's not that easy for us. Like we have to mitigate risk. You're gonna see us being like, hey, it's probably gonna continue all day, and then you'll see us like scaling out of it. That's because we have to actually manage our risk, because that's our money in the marketplace. For new traders, I've been in this situation multiple times where sometimes something tanks and it just tanks so bad that it's not recovering, and you have to take that big loss, and that moment that you're about to take the loss, you hesitate because you didn't expect it. Now, once in a while that happens to me. I've kind of formed a strategy around those kind of setups, but majority of people, like especially new traders, you're going to hesitate, and that's going to cost you your account. So personally, here's a guide that I created on how to kind of like improve it. Now, Cypher, are you listening in on the stream right now?
Yes, I am.
Have you tried the percentage per, you know, uh, percentage of risk method for position size?
Yeah, I used to do that.
Which one do you like better, lots or percentage?
Lots is way easier.
Way easier, right? So that's why I like the dream team. That's what I teach them, is to do it this way, because then you'll never kind of like get frozen up in a trade. There's obviously going to be a certain amount of trades that you can do. Like there's going to be a restriction on the price of the trades, right? Like if you have a small account, you can't be trading like Tesla. Um, well, you could just reduce size. Now, this is the probabilities, kind of similar to the one that you see on the poker side, right? Guys, use this. Print it out, laminate it, keep it on your desk. You want to keep track of your performance, how well you're doing, and the odds that something can go against you. If you don't have these, then realistically, you're just gambling. And there's far easier ways to gamble. You can gamble on sports probably and make more money. I wouldn't know. I really don't gamble, so but I would assume it's probably easier than all the work that I had to put in to get here. So, good question. So, this is based on your win rate, right? So, I want to give a shout out to Meta. She is absolutely destroying it. Her profit factor is 20 times, guys. 20 times on day trades. I have like profit factor on like my investments and stuff, obviously, but nothing like this on day trading sides. Now, you'll notice it's not a lot of size, but you can see from 62 trades, 91% win rate. So from that 91% win rate, and by the way, guys, this is from January 1st, 2020, 91% win rate. Average winning trade $80. Average losing trade 44. Average per share gain or loss is positive 15. And you can see profit factor is 20x. You can see consecutive losses is only 2. Consecutive wins is 31. So looking at that chart, what is the like the odds that she might take 2 losses in a row? What are the odds over here, guys? It's 11.5, right? Based on the probability of consecutive losses. So for her, is it okay to size up? Is it okay to like use more? Yeah, because her stats are telling her that she can. Now, if you had like a 60% win rate, actually, let's go with more realistic. If you are a new trader. So I'm just going to show you one more example. Now, this is a different trader that I'm assisting. Now, again, there's no like right or wrong strategy here, right? So if you notice over here, I'm posting it right now. There we go. It should be uploaded there. All right. So same thing from January 1st, 2020. This trader only 24 trades. Win rate is 50-50 now. Now you can see on the average winning trade though, he makes $412. On a losing trade, losing $98. Average per share gain is $1. Profit factor is 4x. Winning trades, he's holding on for 2 hours, losing trades 1 hour. Now for this individual, can I give the same piece of advice of sizing up? No, because the probabilities of him having 6 consecutive losses is 50%. Right? So you guys see how you can use these stats to your favor and be like, hey, based on this, based on that, I think this is what I'm going to be focusing on. This is something I can improve on. If you don't know your stats, can you do this? Can you honestly tell yourself, oh yeah, I know my stats off the top of my head? No, you can't. A, you need to know where you are before you know where you're going. And B, you have to know like which metrics that you need to improve on based on your trading style. And yeah, that's pretty much it. Like this is some really good information. Please learn game theory. It is actually a lot more complex. You really do have to learn a lot of concepts. And please don't focus on the PNL. PNL, I used to post PNLs. I stopped for that one reason, because it gives them into that herd mentality where it's like people just want to like make as much as they can as fast as they can. And that's not the truth. I don't run a paid server. I don't have to, milk like $300 a month from you guys. Those kind of services, they won't really tell you, oh yeah, it's going to take you 3 years, probably your entire lifetime. You're not going to have, free time. You're going to want to allocate all this time into, trading. Like they can't tell you that, because no one is going to commit for like 5 years paying $300 a month. Nobody. That's stupid. Like if my Netflix membership goes up like $15, I'd be like worried, be like, no, I'm not doing that. Right. So like, who would do that logically? They won't. Right. So realistically, that's why we came up with this theory here. It's like, we'll work as a team. We're going to find those 1%ers that actually want to do better, that don't have to listen to calls, that have their own strategies, that really want to improve, and we will help develop them. We'll work together as a team. I can use my skill sets when it comes to analysis. We can use Cypher's skill sets when it comes to like technical analysis. Like, it's amazing what we can actually get done. The news that people post when Trump is speaking, those kind of alerts help us in our trades. And working together, we actually have an odd of succeeding. And you can see that by just looking at the profit and loss channel. About 99% of the time, if you actually go through the profit and loss, and believe me, I'm analytical, so I actually do look into it because I don't want to see our members fail. You'll notice that on a consistent basis, most of our members make money. I believe that the only times you'll actually see people losing money is obviously going to be based on a few factors. One, penny stocks. Two, just option calls or puts buying, and they tried swinging it without any stops, no risk management there, no hedge to protect it, not a spread. And three, it's going to be because of markets. Like if they're investing and the market goes down, obviously their positions are going to go down. But majority of the traders that actually actively trade, you'll notice one thing, that they are actually consistently profitable, and they have this winning formula down, and it's just working as a team, knowing where they have an edge, knowing when to go in a bit heavier, saving those bigger trades for when they actually made money versus right out of the open. Someone trades, like you are literally betting the moment you get into that trade. If you're going to trade right out of the open, guys, like it's a 50-50. So if your stats is like, your win rate is like 30%, okay, maybe you have better odds of doing that, right? Of just like going in, you have a 50% chance of being right. But for developed traders, we have a strategy. We know which ones there's more confidence in. We know which ones to size up on. We know which one we can hold on longer. We know what meets our criterias. And when I copy, let's say, Cypher's trade, when I copy Tony's trade, I know them. I've been trading with them. I understand their rationale in the trade. I see it as well, and I'm able to participate. For a new trader, you don't have that skill set yet. You don't have that like expertise that we do. So following us into trades is not a good idea. We alert trades on voice when we're making trades for that one specific reason. Because we want you guys to learn, like, hey, this is what they're doing. Why are they doing that? What is causing them to buy it at this level or short it at this level? What do they see that I don't see? And then maybe you can go after hours and research it. But you have to have that drive. If you don't do your own homework, if you don't actually put your effort into this, there is easier ways to make money, guys. This is probably not for you. Oh, that's another thing paid chat rooms can tell you. They'll try and sell you a dream. We don't have to sell you a dream. We'll tell you the honest truth. And yeah, that's pretty much what makes us the best. You guys have any questions?
TJ, I think one thing maybe.
TJ?
Go ahead, John.
Oh, sorry, Zig. Well, I just wanted to let everybody know that TJ's speech here. You got this guy. TJ is probably one of the top individual traders / investors in Canada, in the country. And he's giving you an hour's time right now. Just think of how much you'd have to pay for, or you would have to line that up in order to get this kind of knowledge and advice and insight outside. And TJ is doing this for absolutely nothing. He has very little to benefit from this. So I just want to say thanks to TJ for being so unselfish and so giving. So good job, TJ, man. Appreciate it.
Thank you. I appreciate it. And like Tony says, we're a team. I'm okay with helping out people that are dedicated, but you got to be dedicated. You have to show it. You have to help others out. You have to also be the difference that you seek in the world. And I want the world to be good. So I can't just say that. I can't just like donate money. Like less than 40 cents is going to go to the actual cause that I'm hoping for. That's why we created this, where, hey, we can donate some of our time. We can teach people. The most dedicated people will stay with us. And as you notice, we have members from long time ago. Like since we started, Diago's a good example because he was with us since the start. When me and my girlfriend were trading, he was pretty much there, and he's still there to this day, right? Like we're trying to build a community here that's an honest community, not built on like hopes and dreams of you making, turning $100 into $1 million. And you have really good traders in here that can answer your questions. Please do your homework though, because we don't always have time. We're always trading too. We make an income by trading, and we can't answer questions intraday. And also after hours, I'm doing my research or spending time with my family and friends, so I wouldn't be able to do so as well. And Tony, I actually wanted you on to kind of explain the rules that you posted, because these were rules that actually, like spoke to me as soon as I started trading technically, right? Like trading technicals, right? I come from a fundamental background. So when I was trading technicals, it was kind of like a new environment for me. So yeah, there's a huge learning curve. It's thanks to this group, I was able to like expedite that, learn from everyone, ask questions when needed. But do you like, if you look into it, I'm not going to be the guy that's going to ask a question without at least Googling it first. I'll try and find the answer myself. You have to have that mentality. You don't have to have all the answers. You just have to know how to find them. And yeah, Tony, I'll let you take the floor. Just wanted you to just go over those 20 golden rules for new traders.
Seriously. You want me to follow you?
Yes.
I'll have to. I just want to also want to add the one thing I like about TJ is that he gives me over the years that I've been here, he's given me a lot of institutional insight. So because he has that experience, and I've never worked at an institution or had formal training in securities, that kind of thing. So that kind of insight, and he's been well trained in fundamental analysis as well. So TJ's got a big part of what I don't have. So
that's why
that's
it
the
works
other
out
advantage
so
of
good.
United Traders. Yeah.
Because we can't always be perfect at everything, but as a team, we are fucking solid. And one more thing, Tony is really underplaying this. He has more experience than I believe anyone here, and his experience really shines. Like you will see it in his trades. He is so like precise. He is like a sniper when it comes to his executions. You will see like his risk is nothing. Even if he didn't tackle a trade right, he'll get it on that next trade or the one after. And he has that confidence that he built. Now, one thing also you have to remember, like he is amazing at his analysis. So he's trying to like underplay it here, but his fundamental skills are honestly up to par from the best. So when you listen to something from him, just know it's coming from a guy that has been around and trading longer than like most of us has even like known the term trading. And yeah, you can take the floor now.
Thanks, man. I don't know if well, if you guys, anybody needs to take off, go for it. Thanks for listening to TJ's. TJ wants me to go through these 20 golden rules. I mean, I don't follow all of them, but they're just some good heads up general rules that exist. So we can go through them one by one, and then if I don't expand enough on each one or explain it well enough, to just answer some questions here. So number one, forget the news, remember the chart. You're not smart enough to know how the news will affect price. The chart already knows the news is coming. I think TJ went into this. It's pretty normal. You know, we try to read a news release and we try to go, like, what's going on? How will this affect the price? You know, I'm smart enough. I got a degree or whatever. I read a lot of books, I watch documentaries. I should know how this is going to impact this company. Well, you don't. You just don't know what the agenda is. So, you know, a company could be putting out some good news, you know, just for the purpose of, you know, insiders and market participants to get short on the stock, and then it's going to sell off the next day. We don't know. We have to let price action sort of dictate our behavior and our trading. There's a lot of tricks out there. The other reason that you gotta there's a lot of I'm quite the skeptic, and I always feel that, you know, things are always manipulated. It doesn't matter how small of an entity or how big of the entity is. It's being manipulated. It doesn't matter if it's crude oil, Facebook, or a low float ticker. They're all manipulated to some degree, and there's orchestration, you know, in the work. So it's hard as a, you know, anyone that is sort of you know, a professor like Ingo, you know, or a programmer or whatever your background is, lawyer, student, you name it. We all just don't know what's going to happen. Enough said about that one. Used to be the worst at this. It's so easy to have a bias, you know. You know, man, you know, Zuckerberg, he's going to go testify, his stock's going to tank. Yeah, Facebook's dead, whatever, you know. The guy opens his mouth and boom, stock just starts rocketing, you know. It's just all planned. So you just can't have biases. Biases will kill you. Play the price action. All right, buy the first pullback from a new high, sell the first pullback from a new low. Always a crowd that missed the first boat. Pretty self-explanatory. You know, you're listening to the scanner that we got, and all of a sudden, you know, a ticker comes across the voice, and Bitchin' Betty says, you know, whatever it is, DPW or ZM, you know, and then you go and look at the ticker, and there's been a big pop, big 10% move on it. Now what do you do, right? Do you jump in here at the top of this initial pop and hope that it keeps going up from there, or what? No, you don't. You have the discipline, have the patience to, you know, wait for a pullback or some kind of consolidation, and it breaking out of that pullback or that consolidation before you make a long entry. Same thing with a stock that's doing the opposite, that's tanking. You know, it starts tanking, you get your first look at it, you go, oh wow, thing's dropping. You could join in and try to, you know, follow momentum if you're a really good tape reader, and you might have caught it really early. But if you don't, you got to play it safe. You got to wait for the first, you know, round of covering and it pulling back, you know, going back to the 12 EMA or the 20 EMA and touches that, and then that's where you start your short, you know. And that's where it says there's always a crowd that missed the first boat, and that's exactly what people are doing. And on that next top, they're shorting, you know, or that next pullback, they're buying. Good enough? All right.
Yes, sir.
If you're still around, TJ, just jump in when you got anything to add, man.
Honestly, I don't think so.
Okay.
Oh,
Well, just at any time, just freaking jump on.
thank you.
Buy at support, sell at a resistance. Everyone sees the same thing, and they're all waiting to jump into the pool. Pretty straightforward. You there's some support levels and resistance levels, like previous support levels, previous resistance levels. You have to have them on your chart somewhere, or you have to be aware of them. They're always going to be points at which they're inflection points, and people trade off them. And the more people that trade off those inflection points, that's where you're going to get the moves, and that's where you're going to get the direction that you need to trade. So you have to plot those on there. So the first thing I always do whenever I open a chart, especially if it's a new one, is I will look at the dailies. I will maybe draw a couple lines. I'll look at like an hourly, try and draw a couple lines, and then then I'm down into the 2 minute or the 1 minute, and I'm looking where those highs relate to where the stock is now, right? And then in addition to that, I've got some moving averages as well, and then you got to have those kind of things up that most everybody uses, because the more people use it, whether it's a support level or a moving average or VWAP, the more price action is going to result as a result of those people using it. So you don't want to be the only one not using it. You don't have to use it, but you have to know where it is. You have to know that that's an area where price can react. So that's number 3. Anything to add there, TJ?
No, you explained it perfectly.
All right. Short rallies, not sell-offs. I don't know if that's a really good rule. What do you think of that one? When markets drop, shorts finally turn a profit and get ready to cover. That's almost like number 2, selling the first pullback from a new low or something.
I mean, we get short squeezes, and we kind of saw that on the market recently. People were like short in every direction. You can actually confirm this if you take a look at the put and call ratio on our scanners 4 days ago versus today. People got squeezed out of those short positions, and you're gonna see that it's gonna rally faster. Because remember, shorts, like, they all have a stop loss. When the stop loss gets traded, it's usually a market order. And again, if they're trading with options, it's gonna like increase that force on the equity side.
Buy up into major moving averages or sell down into one. If people that have been following my posts on the chat often see me posting a daily chart with a red line, and it's the 50-day moving average. And I don't know, I don't do it all the time, but that 50-day average is works like clockwork. You'll see stocks that have tanked and they're rallying, and they rally right back into that 50, touch the 50, then bounce off it, etc. So what number 5 is saying, if you've rallied up into like the 50-day moving average and it's bumping up against it, well, that's resistance. That's an inflection point, the 50-day. Enough people in the world use the 50-day. So you've got to pay attention to it. You got to either cover half of your position there, and maybe ride the next with a tighter stop, the next half of another stop, etc. And the same with it the opposite direction. 200 days, another really important one that you don't want to ignore either. You should try and plot that as well. Don't chase momentum if you can't find the exit. Pardon me. Low floaters or the scanner callouts, which is kind of funny. You see, oh man, it's FOMO. Jesus, if I don't, I gotta buy this now. Like, when I enter a trade, my entry, I'm watching the tape. I've got a few levels out. I'm this thing might have gapped up 50 cents, and before I'm entering, before I even think about my entry, I'm thinking, where am I going to stop out of this? So if you're, I have to have that in mind, because, and that's why you don't chase, because you don't know where you're going to put your stop if you're chasing momentum. Where are you going to stop out? Where are you going to be wrong if you're like chasing a stock that's running away from you? and it's already moved 50 cents. Are you going to set a stop 50 cents from like where it took off? Is that going to be your stop? Like that stop loss is huge. So when I see momentum and I want to get in and be part of that momentum, I need to have a place where I can put my stop in reliably and be proven wrong. And that stop can't be too far away from where my entry is. Because the bigger you leave that gap between your stop and your entry, the bigger the loss is going to be. So I'm always trying to get the least amount of room between my stop and my entry as possible, especially when you're trying to chase momentum, because it can just come back and slap you in the face, and then you're hooped. You just took a 10% drawdown on your account.
All right. So for this one, for number 7, to be honest, gaps are something tricky. Identifying what kind of gap it is not easy. It's not something you can actually notice. So I actually put down a cheat sheet that I kind of created, which will help you identify it and see how it kind of worked out. And it'll give you a brief description of it. I don't think I can like put it into words any better than what's written down over there.
I'm not an expert on gaps, and they're not part of my strategy. I find them still pretty unpredictable. Unfortunately, I don't have a good win rate trying to play gaps.
Same here. And to be honest, like unless you're a swing trader, this isn't something that's going to be factoring in onto your trades. But I kind of look at it like, hey, gap in price. Okay, I missed. You guys notice that some trades I'll just sell before earnings, even in my long-term portfolios, because I don't want to expose myself to risk or lose any of the appreciation on that stock itself, right? Now I look at the gap afterwards. It's like, oh no, it gapped up. You'll notice it'll come back down depending on what type of gap it is and why it gapped up, based on their earnings results. Was it more than the market? Now that's something, honestly, I'd say for new traders to completely avoid. What do you think about that, Tony?
Gaps, yeah, I agree. All right, so 8 trends test the point of last support and resistance. I guess that's like, yeah, there you go, good chart. That chart up, you can talk about it.
All right, perfect. So as you can see on that chart specifically, you'll notice that been in 1 minute, but looking at the series of transactions, once I got that under wraps, it became a lot easier.
Yeah, Johnny should almost do. We should line Johnny up for a lesson on his sort of tape reading and his methodology of what he's looking for. Those characteristics in the level 2 in the tape. We hear him talk about it, but it'd be good to hear his.
Yeah, we should definitely do that.
Explanation of that. Yeah. If you have to look, it isn't there. Forget about your college degree and trust your instincts. Kind of like a few of the other rules. I don't know if that one needs any explanation. Sell the second high, buy the second low. After sharp pullbacks, the first test of any high or low always runs into resistance. Look for the break on the third or the fourth try.
I think that speaks to like the psychology of those trades too. Like if you look at any like let's say a triangle formation, you're gonna notice it's always that third or fourth that actually runs. The rest is just like consolidation on price until buyers or sellers get in control.
Yeah. Yeah, just basically don't think it's going to reverse on that first, on that first reversal or that, first low. You can, always make, it's usually at least, I don't know if there's anybody that's into Elliott wave here. I think I learned a little bit of Elliott wave probably about a decade ago, but it never really took to me. So they believe in, like 5 waves essentially, right? And that's what this one's sort of talking about. You have better odds in the 4th or 5th wave for reversal essentially. Oh yeah, the other thing about the tape I just want to mention too is like I've actually not this year, but like a couple of years ago, I actually went and like when I was sort of okay, I gotta figure out this tape better. I would sit there, watch the tape, and try and make a prediction and just put a checkbox. Okay, this is going down, or this is negative money flow, and then see if I end up being right. 30 minutes later, go to another ticker, do the same thing, watch the money flow, watch the level 2, put a checkbox, and just see how accurate I could become watching the tape. So you got to watch it, but you got to see, and you got to try and feel it, but then you got to know what your results are, and you got to know whether your feelings and what you're seeing is legit or not. So somehow you have to kind of track yourself and track what you think is going on in order to prove that you're right and you're actually getting an intuition about it. Back to the trend is your friend in the last hour as volume cranks up. Don't expect it to change the channel.
I'm horrible at trading after 3, so I'm not even going to comment on this.
Today I was telling you, I said, wait till 3 o'clock for reversal. Wait till 3 o'clock for reversal. I posted it a couple times in the chat, and that's they're going to switch the algos, and sure enough, they did. They kind of went the opposite direction there. So I thought that was kind of funny. Yeah, it's not a hard, fast rule, but especially in this market where it's so volatile, I guess it's a generalization. Yeah, but power hour is power hour. There's some big moves in there, and usually they're in the direction of the current trend. So that's just saying to stick with it. Avoid the opening. Okay, I got a screenshot here of AMD today. This is, some of you guys have heard me talk about like market maker tricks and how basically they're doing the opposite of what people think is going to happen, and they're just suckering you in. This is so true, and the open is like the best place to do it. And yeah, you can make a lot of money at the open, but man, you can get screwed at the open too if you don't play it right. So many games are played out of the open by the market makers and the toots that you got to be really careful. So it's probably good to just avoid that first 10 minutes if you 5 minutes if you're new to trading. I wouldn't guess it. So this is the first 30 seconds of AMD here. I just posted. See that one big bar and 1 million stuff. Look at that. If you went short at the open at 48.90, you would be went all the way to 49.25 in 30 seconds. And so let me show you after that. Even higher. So just think, price action is telling you like, holy crap, this is really going here. This is going to run, and then they just dump it on you. I didn't even look very hard. This is what they do at the open. This is what market makers and institutions do at the open. Opposite game, get you going like it's going long, and then just drop it on you. They're just setting up their shorts while everybody's buying into that, and then they're just releasing the hound. So that was the first chart was 30 seconds. The second chart I posted was 1 minute. After that, it just kept going down. But you see how it popped, and then it just kept dropping. So actually, what it did in the open was the opposite of what it did for the next couple hours. Was it a couple hours? Yeah. $14. We're getting there. Still got some people with us. 1, 2, 3. Drop up. Look for downtrends to reverse after a top. 2 higher lows. Kind of like the number 11. Yeah. Reversals don't normally happen like in a V. And just like a one-time drop, and unless it's sort of a stop loss hunting or something of that nature. So it's just saying that don't rush into something that's downtrending. You're going to have time for it to reverse, and there's going to be look for a lower high or a double bottom, or look for some RSI divergence on that. You probably heard TJ today when he was here TJ posted that chart. Go for it.
Yeah. So I like mean reversion trades. That's my specialty, only because like I already account that it's going to go against me, and I'm okay. I have a bigger risk appetite, so as long as I know which direction it's going to eventually go, I'll just take the trade. And if I think it's at a decent level, I'll start going into it. Now you'll notice, yeah, RSI went lower, but it's been on a constant downtrend just by looking at that picture. So you might think it's the bottom and it's just going to go more against you. Now, typically, I like this strategy only because I can take more size in while everyone is just like running for the fence. I'll be able to like absorb some shares and be able to take some size in. And then when that reversal happens, you'll notice there's always going to be that little consolidation because people like me are going to be like, okay, this is over my average. I'm going to reduce some size. And then afterwards, it's going to like consolidate. And it's like, okay, who's in control now? If buyers are in control, it's just going to move back up. This is a clean V shape. Usually it isn't. Usually it's like a double bottom, and or even a triple bottom before it actually starts moving up. So RSI for me is key just to see if we're actually trending up, if there's hidden divergence there. Are we actually going at the bottom, or is this going to continue down? Now the bulls live is that one's also I think on like the daily chart too. Like you you're gonna notice this too. Like stocks are very bearish, and when you see a pop, like it's number 15, bulls live above the 200-day moving average, bears live below, right? So one thing that I like about this too is like if it's below that 200, you're gonna see a lot of shorts on it. So any spike that happens, any pop, you're gonna get that quick short squeeze. So I like to use that to my advantage to like kind of like go on the long side, vice versa for the bullish side. Everyone's just waiting. Everyone's happy. If you're trading above the 200, that means most people and market participants are, in the profits. So the real question is, when do they sell? What's causing the sell? If it's something really bad, like some really negative news, like they canceled their one drug that was in the pipeline that everybody had high hopes for, like AMRN, for example, you're going to notice it's going to tank extremely fast.
200-day thing is it's kind of like the 50-day I mentioned earlier, and it's a good place. Basically, like if you want to look at it even more generalization, is like one of my checklist items is am I on the right side of the moving averages and VWAP for what I'm doing? So if I'm going long, are we above the moving averages that I'm using, and are we above VWAP? If I'm on the right side of the 200-day or the MAs or the VWAP intraday, etc., your odds for being right and trading in the same direction as price is better. It's higher, right? But now if I'm trying to short something that's above VWAP and above its moving averages, that's counter trend. That's lower probability for success, etc. So I think number 15 is just basically saying that you for whatever you use, make sure you're on the right side of that momentum. And the 200-day is just one that's one of many that is major with institutions. Says memory, what did price do last time? So this just goes back to the support and resistance levels. In one of the other rules, number 3, I think it is. So you got to go, back on the chart, look at what price has done at those levels in the past. Other traders are going to do that. Institutions are going to do that. So if everybody's doing that, then you better be doing that, because something's going to happen. At that price, it's either going to stall out, or it's somewhere where you need to reduce your position size because there's a potential bounce coming, etc. So that's don't forget the past. Chart the past forward.
Yeah, and personally for me, like that's why I trade price levels. You can kind of see it. The traders that we trade, like, depends on the stock. I mean, if you're trading like something like Berkshire's, that's a lot more institutionals. But when we trade the stocks that most day traders trade, you want to trade the day traders. And the common perception is, hey, this is a support level. We broke over it. There's some interest that caused it to go over. And now we're testing that support level again. You know, you're going to see that there's more volume and you're going to see more people getting in because they missed the first run, or vice versa. Maybe they're like, okay, this is my stop loss. It's at break even. And as soon as it crashes down, it's going to just continue, plummeting down.
17. Big volume kills moves. I think this one is more about, like, when I think about this and I think about some of the manipulation that goes on, some of the stop loss hunting that goes on, and sometimes you just see it. You see these big wicks and huge volume, and then you see reversals off, or candles that will wipe them out subsequently, and usually market makers or market participants, when you see those spikes or those tweezers or what have you, they're very good areas that big money got involved, or there was a big I don't know, a big negation in what was going on. So when I think it was just a couple of days ago, we were watching, I was on and Cypher was on, and the ES was climbing, and then we saw this, basically a big wick for no reason. It sold off right away. The volume was huge. As soon as you see those kind of blow-offs in price and with a lot of volume, you got to be careful. That means something's going on. Either they just took out a whole load of stops, but the price held, or so a big seller came in or a big buyer came in, vice versa. But you have to pay attention to those volume spikes and those price spikes, because that's where something's up, something's changing. So trends reversing there, or that's the end of the current trend, something to that effect. So I don't know, you could probably expand on this one a bit better than what I did, TJ.
No, I think you're right. Like, we look for volume because it's a volume precedes price. If you believe in that theory, then near the top or a bottom of a trend, you're going to notice accelerated volume. So that's one thing that we look out for. Johnny looks out for. I think all of us as traders, we look out for that. When we're in a position, we don't know where the top is. We're not here to like predict what's going to happen in the next, like series of candlesticks. We just have to manage our position, and within that trade management, the one thing we're going to be looking out for to know, hey, when is a good time to get out, is going to be that volume. That indication on the volume will tell us what's going to happen next. I actually have a chart that can really quickly describe it as well.
Yeah, I got just looked at. I'll post this here too. I was just looking at this is what happened today when I was trading CCL. Look at the bottom of that of these this chart where it bottomed. Look at the volume where this bottomed today, and we had quite a spike down. Huge volume came in, and what this number 17 rule is saying, that basically after that, the trend pretty much stopped. It didn't go much lower. It actually went sideways, maybe reversed a little bit, but that volume stopped the move in its tracks. So you got a chart there too?
Yes, I do. And you'll see it on SPY too. You'll see it on pretty much anything. And that's why we use it as guidance as well. So if you notice, take a look at that volume that came in as soon as that support level broke on SPY, and you'd notice the massive selling that came in, and look how far it kind of dropped. You know what? I'll post a proper chart with the actual time and stuff. And you'll also notice when we bottomed out, you'll see that volume continued and then it continued back up. But yeah, that's pretty much the general concept. Volume price analysis is important. Anna Cooling can explain it in such a good way. We're not gonna waste our time trying to, like reinvent the wheel, because she did a phenomenal job of explaining it. And I suggest everyone. That's the second book you should ever read when it comes to.
Yeah, and the next two are kind of similar. Trends never turn on a dime. Reversals build slowly, and bottoms take longer to form. Yeah. Well, let's do separate, I guess. Trends never turn on a dime. So, yeah, very rare do you get like a V shape, a really harsh V shape reversal. Usually, it's just like when the manipulation's happening. Will you see the V shape? 80 to 90% of the time, it'll take some time to reverse directions. Of course, unless it's like a low float ticker or
I
something
was
like
about
that.
to just say the same thing.
Anything's possible with one of those. Yeah.
Nothing matters at that point.
Yeah. Yeah. Bottoms take longer to form than tops. Greed acts more quickly than fear. So true, isn't it?
So true. Like you have to remember
Takes the
a
stairs
basic,
up, elevator down.
yeah, and you have to remember like the market participants. Again, this ties in with everything we were talking about. When someone's long on a position, they don't want to take a loss. Remember, you're trading other traders. You're trading swing traders, guys that are holding on, and they're like, okay, I'm down now $5,000 on my portfolio. Half an hour later, they're like, okay, I'm down like $6,000. They're like, okay, now I got to make a decision. If this fails, am I going to get out? But that limit, like how much the person is down, their risk appetite, that's always different. So you're going to notice like it takes a little bit of time before it actually comes back up. You do have to give it some breathing room, because not everyone's stop is always at the same place. Now, greed is always the same. They get in because they have a catalyst. Now, in a perfect market efficient theory, like explanation for this, it's like if there's something that hasn't been priced in, it's new news, everyone's trying to trade that news, you're going to notice that people are bullish. So you're going to see that those big bullish runs are going to be fast, it's going to be rapid, and most likely it's not going to like last, and it's going to revert back to the mean.
Yeah. I don't know. Beat the crowd in and out the door. Yeah.
Oh, that's my favorite. You got to be first in, first out. That's why I always take proactive entries. I don't like to take entries where people are trained. It's like, buying the top of a flag breakout. For me, I don't want to get stopped out within the middle of that flag. Like, what if I bought the flag breakout and then it came back down within like its range, and then I just stopped out? I prefer buying it at support, and that's why I always suggest buy at support, short at resistance. If you buy it at support, if that trend fails and you stop out, at least you know that trend failed. Now, if you were to buy the breakout, right, and you'll see this, you buy the breakout and you think it breaks out, it goes up 10 cents, you're happy, and then it just crashes 20 cents. You're still within the support and resistance range. I don't like stopping out in that range, because the moment I do, guess what happens? It's actually going to break out. And that's why I always suggest, like, if you're going to be monitoring your risk, buy the support on it. And you'll see me on even double bottoms. I'll test it out. If it doesn't hold, I'll just get out and just do it. It's probably not a double bottom. It was probably just a bull trap, and now it's just gonna continue on its downtrend like SPY today. I
Yeah.
hit it on my own
Head and
girl.
shoulders.
Yeah, exactly.
You caught the shoulder and then you had to catch the head too.
Yeah.
Yeah, beat the crowd in and out of the door. The other thing I think about when I read that out loud, in addition to what TJ was saying, is just sometimes I pay myself too quickly, and Johnny's been bugging me to hold longer, but on the bulk of my position. But when I get a profit or a stock makes a move and it goes into like a little range or whatever, I'll take some off the table there quickly, and what that allows me to do is to bank some money, so that I've got less probability of it there being a loss, and it also gives me more patience with what I've got left. So if I took off a third and I got only 2/3 left, well, now I'm not so antsy or tight about hanging on to this a little bit longer. So paying yourself quickly, is a good thing. And then if it does go in this constant consolidation and it starts pulling back even more, well, I got another third. That third that I just took off, I can add it back on if I still, if it continues to stay above it. So I see a lot of people that have direct messaged me, and they're doing single one-time trades, right? So they're going all in, all out, all in, all out. So, the scaling is one thing that Johnny and TJ have sort of preached over the last few years, has really helped my trading in doing that. So get that first little profit off, get some patience, pay yourself
Yeah, for
quickly.
me, same here. That's helped me tremendously because I used to chase too, because I went full in, full out. And then I have to chase. Then
Yeah.
I'm like, oh damn it, it's going up more. I have to get in again, right? And then what ends up happening is that second trade is just gonna blow every profit that you just made on the first or second trade. And that's gonna happen because you already made profits. You're comfortable with the stock. You built your confidence up on it. You think it's gonna keep running. You actually didn't zoom out of that chart and realize it just fucking gapped up 10% when a stock barely moves up like less than like 2% in a day. When it's only after the fact you'll kind of notice this. While you're actually trading it, you're going to be so active. You're going to be like, hey, the tape's so green, I'm going to get in again. This is my opportunity to like make big bucks. And guess what, you just are going to be slaughtered on that third trade, and you're just going to lose it. You'll notice also from Tony's trades as well, that he posted over there, that he doesn't just buy, get in, and then re-enter again. He gives it a little bit of time, sees, okay, is there another opportunity for me? So if you take a look at that first trade that he posted, he got out, but then, a normal, like a new trader is going to be like, okay, I'm going to get in again because it's going to continue. But instead, he gave it some time. He's like, okay, I see that it moved up again. Now it looks like a good time to get on the short side. And he shorted it again. And even on that last one, like he was able to scale out and actually capture majority of that trend. And that is like what like proper risk management is all about. It's capturing the majority of it, but reducing that risk exposure. And because of those two previous trades, like I can pretty much tell you by just looking at it, well, the three previous trades, you can tell that on that fourth trade, when it's going in his direction, he held on to that one longer because that's the sucker that's going to make the bank. And that sums up everything. I know this was a long lesson. I really didn't plan it, but Tony, I really appreciate that you came on and shared your insight as well. Because it's one thing to hear it from one trader, but to have it from like two experienced traders, it's just way better. And yeah, I hope you guys learn from this experience as well. And please do some studying after we're done.
Yeah, and then, like I said earlier today, put it in practice. You can study and train your brain, but you've got to train your body too. So, paper trade or trade with one share or 50 shares or whatever it takes, but get that screen time in addition to your knowledge. You got to do both. Can't just do one side of the equation. You got to do both. So all the best. Thanks, guys.
Thank you so much. I appreciate
Thanks,
it.
TJ. Cheers. Bye.
All right, guys. I think that wraps up our live lesson. Again, we haven't really prepared all of this stuff, so I'm really glad that he was able to share his insight. Since he's an experienced, seasoned trader, I know most of this stuff would be like, fresh in his mind. It's always good to get someone else's perspective on things as well. So, yeah, if you guys have any questions, just write it down on the group study. I'm going to go finally eat some lunch. But if I do have a chance, or any of our other members here, they'll be able to pretty much answer it for you. Take care, everyone.